We're officially into the new decade, though market conditions won't be returning to full form until next week when participants return from the holiday break. As to be expected, there isn't a whole lot going on as far as market moving influences go. We had seen some broad based US dollar selling as 2019 came to a close, and after such an aggressive run, we're now seeing some mild profit taking as the new year gets going, which again shouldn't come as much of a surprise, especially in these thinner conditions. If there's one currency that stands out of the more developed currencies, it's the Canadian dollar, with the loonie closing out 2019 in style, making a yearly high on the final day of the year and trading to its highest levels against the US dollar since the fall of 2018. The move was perhaps accelerated after the major psychological barrier in dollar CAD was taken out at 130. The pound has been well bid as well, though we're less inclined to highlight this price action, with the currency having already been pushing up in the aftermath of the UK election and having broken no new levels of consequence just yet. On the equity side, we haven't seen any change in the picture. US stocks sit just off their record high set the other week and continue to feel good about central banks at their back as those balance sheets balloon back up. This isn't going to end well, but at the same time, the market isn't worried about that. If all signs from central banks show, it doesn't need to be worried. But the writing is on the wall, and with central bank policy accommodation so exhausted, it can't be much longer before we get that grand capitulation in stocks. Look no further than the price of gold, which has been making its way higher and higher in recent weeks. It seems the yellow metal is definitely feeling added tension that lies just beneath the surface. That's all for now.